This video has potential to save you hundreds of thousands of dollars in your 401k. I've seen this with my private coaching clients lately, and this small change that we've done has saved them thousands, if not hundreds of thousands, over the life of their 401k. Most people invest in only one place, which is their 401k or 403b, and that's through your employer. And so if you invest there, you need to go check on this right now. Most don't know that you can actually change what you're invested in, and you probably should. The default account that your employer puts you in probably is not your most optimal and actually makes them a little bit more money. The issuing company that holds the 401k charges crazy fees, so I'm going to show you how to check those hidden fees and then also how to switch into something that's probably more optimal for you to actually grow your money much faster. Assume you're an employee with 35 years until retirement and a current 401k account balance of $25,000. If returns on investment in your account over the next 35 years average just 7% and fees and expenses reduce your average returns by 0.5%, your account balance will grow to $227,000 at retirement, even if there are no further contributions to your account. If fees and expenses are 1.5%, just 1% higher, your account balance will grow to only $163,000. The 1% difference in fees and expenses would reduce your account balance at retirement by 28%. 28% on a $1 million portfolio means that you would be losing out on $280,000 just lost to fees. And that's just from picking an account that has a 1% higher fee. So in this video, I'm going to take you through my actual 401k, or actually it's called a 403b, which is basically the exact same thing. It's just what my university issues. If yours is like mine, the options within it have a bunch of weird names and weird symbols, and it's hard to actually articulate what's actually going on. But I'm going to walk you through a couple of them to show you what each thing means and how you can do research yourself no matter what type of company your 401k has. My name is Nolan Govea, my students call me Professor G, and I made this channel to make investing simplified. So my company's 403b is called Guidestone, but it doesn't really matter what yours is. It's going to be very similar, and I'll show you in a second. So what we're going to do is we're going to get to a place that says something like manage your investments. And for me, it's future investment elections. So we're trying to figure out how we can change these things. When I click into here, we can now see the different types of things that I have. Obviously, I don't have a lot of options, and some of you probably have more. But as we can see, there are names and things that I have no idea about, like the Guidestone Equity Index or the Growth Equity or Small Cap Equity. I have somewhat of an idea of what they are just based off of the name, but I don't really actually know. Now for my fund, I could put, if I wanted to, a percentage in different ones to equal out to a total of 100%. Right off the bat, like I've talked about in different videos, I have 100% of my 403b in this one, the Equity Index, and we'll start there. And the reason why I have 100% there is because that's the S&P 500 fund. As you can see here, we're looking at the performance included in the S&P 500 index. I looked around at all the different funds and saw that this one was the best for me. It has an expense of 0.12%, which isn't that high for a 401k or 403b. Year to date, it's at about 15.67%. The first thing that I looked for is the asset allocation and looked at the benchmark. It's 100% the S&P 500 index, and that's what I wanted. As you can see, the top 10 companies are very similar in percentage as the actual, VU or something else that I talk about on this channel. You can see the different type of sector holdings. And so I just checked it against the actual S&P 500. And that's what that was there. Going back here, like I was talking about, if I wanted to, I could put 50% in this one and 25% here and 25% here. If you have that option, then great. You could do something like the 3-fund portfolio if you want to, or if you wanted to be a little bit safer and have some bonds and have some S&P 500 or have some growth, great. So that's what this means on the side here if you've never done this before. Anyway, let's go through a couple of different ones so that you know what to look for and how to do your research. So obviously I don't know what this one is, the Guidestone Value Equity Index. So let's click on that. We can see here that it tracks the Russell 1000 Value Index. For me, if I don't know what that is, I'm going to copy that and then I'm going to put that into Google and just kind of look it up. So if we're looking at the Russell 1000 index value, we can look at something here. So this one's very similar, IWD, which would be the ETF version of this. We can look at the performance. Okay, the 10-year, it's had about a little over, or it's almost about 9% per year, which is pretty good. We kind of want to look at a little bit more. So it has about 850 holdings. That's good to see. We also want to see what types of companies make up this account. And it's some solid companies like Berkshire, JP Morgan, Exxon, Johnson & Johnson. Good. If you wanted to see, exactly which ones, you can look all the way through if you'd like to. You can also see the exposure breakdown. And so when we go back to the actual Guidestone account, we can see that the fee and expense on this is 0.26%. Now, if it's tracking the Russell 1000 value index, we can look at how much is that. Okay, 100% it's tracking that. So remember this fee here, 0.26%, when we go back to the ETF version, we can see that the fee there is only 0.19%. So it's obviously a little more expensive within the 401k or 403b, which is totally normal. But as you can see, when you're looking through this, it's kind of tough because it doesn't actually show what types of companies are involved. And sometimes it's just, the types of information that they want you to get. The more things that you click through, you probably could find more of the companies involved. But what I like to do is look for the actual index that it's tracking. And if it says it's tracking at 100%, then I just go to that index specifically and look at the holdings on my own. So now going back here, we can look through each one of these. Now, if it says something like US equity, that just means that they're US stocks. So we just looked at one that was a little more value. We looked at the S&P 500. Now we can look at one that's maybe more growth, because growth is just a fun one these days. So if I was looking at this one here, this would be something like QQQM or VUG or something like that. It's looking at a portfolio of large and medium-sized US companies whose equity securities are considered to have above average potential for growth. So it's very similar to, like I said, QQQM, SCHG, things like that. One thing to notice right off the bat, though, is it's a 0.66 expense, which is very, very high. The year to date, though, is at that 20% range. So what we can look at here is we can look at the top 10 equity holdings, right? The Microsoft, Apple, Amazon, things that we're used to seeing. We also see that this has tracking 100% the Russell 1000 Growth Index. So let's look again. The fee is at 0.66%. If we look at the actual index itself, and we can see this one, IWF, a different ETF that tracks the exact same thing. First of all, the year to date is higher, but the expense ratio is only 0.19%. So like I said before, the fees within the 401k, 403b are very, very high for certain accounts, so you just need to be careful. But within your investing possibilities within the 401k or 403b, if you did want to have some growth and you did want to have some S&P 500, you could go like 50 there and 50 here and make it that type of a portfolio. Yes, the fees are a little bit higher, but you just have to understand what you're investing in. And real quick, when I'm talking about these fees like this, the reason why I'm saying this is because in some of my videos, and you'll probably see this on other people's videos too, we'll say something like, take the 401k match, but maybe don't max out the rest of that until you put funds into a Roth IRA or IRA. And the reason for that is because the fees within the 401k or 403b are always going to be much higher. As you just saw, if you were just to invest in the exact same thing, an ETF that tracks the exact same thing, the fee was way, way less expensive. So that's the reason why we say that you want to take that match. But anyway, let's look more at these funds. So that's the US equity, and so we have different ones, large cap and small cap, which just means larger companies and smaller companies, and you can do your research on that. Then we have the non-US equity. So this would be something like international funds. If that's something that you want to do, you just want to see, okay, what type of index are we talking about? And I would just go directly to try to figure out what's actually in the index. This one just talks about the actual index itself. You can see what's happened here over the last 10 years or so. It's had an average of 4.60, which isn't great, but it's just good to understand. We also want to know what type of countries are involved here, the different types of sectors. It also talks about exactly what specifically invested in, and here's the top 10 here. It's just good to understand what exactly you're invested in. So we have different types of non-US equity. Then we have fixed income, which would be something like bonds, possibly the money market. These are just going to be much safer as far as keeping your money stabilized. And so if you wanted to have a portion in bonds, like 10%, especially if you're getting closer to retirement age, this might be a good one for you. You can also just click into it and see exactly which types of bonds and what types of things if we drop down and look at it. Now the fee on this is really high, 0.58%. The return hasn't been very good at all, but you can see that it is yielding about 4.77% of a dividend. You can see the benchmarks that it is indexing, and you can go and see what is the Bloomberg US Corporate High Yield Index or the JP Morgan Emerging Markets Bond Index. Check out what those are the exact same way that I just showed you in the other funds, and then you'll know exactly what to invest in or what you're investing in. In here, we also have things like real estate and then strategic alternatives funds. And just like I've shown you from before, you'll just click into each one, and that'll make it so that you know exactly what you're invested in. Now, like I said at the beginning of this video, you're probably already investing in the default account that's gonna make this company make the most amount of money. It's gonna have one of the highest fees. It is an okay account for you to be invested in. I just think that there are better ones, especially if you do your own research and you understand your risk profile and know what you're investing in. You can kind of make this the same way yourself, and it's very simple. It's basically just that 3-fund portfolio that I talk about a lot in my videos. But let's look at what you're probably already invested in. I'll explain what it is, and then you can make your decision on if you want to stay invested in that or if you want to switch to a lower type fee fund, which I hope that you do. So the one that you're probably invested in is something like this. It's gonna say some type of a name, and then it's gonna have a date. And what that date basically means is the date that you're probably going to be retiring. So right now it's 2024. I have about 30 more years until I'm gonna retire. So the one that I think I was defaulted into was this 2055, and it's just basically a target date fund. So let's look at it. When I click on that, it has an expense ratio at gross of 0.49 or net of 0.45%. So it's already way higher than a lot of the other ones. The cool thing about these target date funds is they do have you in different types of asset allocation. So for this one, the fixed income is only at 5%. Bonds or so is only at 5%. And then stocks, US stocks is 63%, which is much higher. And then international fund is 30%. The reason why this is a little more aggressive is because it's for younger people like me who have 30 years or so for this thing to keep growing. I don't need as much bonds. The cool thing about these accounts, which I'll show you in a second, is the closer you get to retirement, it automatically rebalances. So they'll put more in fixed income and less here and less here. We can see what the actual portfolio holdings are, and it's that equity index fund from before, which means the S&P 500, and then a small cap and some defensive market. They also have these types of international funds, so we do know what we're getting here. So like I said before, that was the 2055. Let's say you're going to be retiring in a year or two, you'd be in this one here. As we can see, high expense still. The year-to-date average has been much lower. And if we look at what it's invested in, it's in so much fixed income, a lot of bonds, 42%. Remember that one before was only in 5%. The international is 13%, and then the US equities, or the S&P 500 basically, is 42%. You can see exactly how it breaks down here, and it did that automatically. It moved it every couple years, every 5 years or so, it's gonna move you into something that they deem as a little bit safer. For that though, they're charging you a pretty high expense, and you don't have a lot of control over what you're actually invested in. Because for most of us, or any of you that are 10 years or more away from retirement, you really shouldn't have very much bonds whatsoever. So let's look at one more. If you did have about 11 years till retirement or so, maybe more. If we looked at exactly what that's holding over 25% in just bonds. That's really keeping the amount of growth possible in your fund very, very low while charging you a very high fee. And I just really don't like that. The idea here is just to understand the different types of accounts that you have available to you, and then picking a fund that makes the most sense. I have 100% in the S&P 500 here because, like I said, it has one of the lowest fees possible at only 0.12%. And then I invest in my Roth IRA and other retirement accounts in the other two funds that I talk about from the 3-fund portfolio. So I invest in my dividend or SCHD, and then growth, QQQM or SCHG, heavily in those accounts. So it balances everything out and gives me that 3-fund portfolio. So fees in a 401k or 403b are usually much higher than that in an IRA or a Roth IRA. But if you get a company match, you should definitely take that match all the way to the top. But then with the rest of that money, you definitely need to know what to do with that. This video goes over what you should invest in first and in what order and how much based on how much you're making. Or watch this video to keep you going strong in your investing journey.